go right into kind of what we're about. Baker Milligan really focuses on farmers and their families. When I first bought the business, this was one of our biggest industry of clients. And so this has always been, I purchased the business in 2004, and this has always been a focus of ours since then. We also serve some small and medium-sized business, as well as individuals and families that are either associated with those businesses or are close to retirement. So we have got a focus on helping people transition from their farm or their business into retirement. And these are going to encompass business owners and their families as well. And then really what we want to make sure that our audience knows is that our focus really is on farming and agricultural business. And we want to be able to provide that year-round support to those businesses. We believe that consistent touches and consistent processes are always going to lead to better results. And it's going to really help us develop better relationships with our clients if we're consistently having touches with them and able to understand their business versus just one time per year show up, do a tax return, and leave. So Jake is going to talk a little bit about how our BOSS packages work and why that's important with our processes.
Yeah, so a lot of our clients, especially the ag clients, is we know what services that give them the most value. And so we built those into 3 different tiers. And so all 3 tiers have tax prep, tax planning, end of year payroll and 1099s as necessary. But we also build into those in all 3 of these tiers is unlimited phone calls, emails, and questions. At the end of the day, we want our clients to call and ask questions when they have them and not feel uncomfortable or have any fear of getting additional billings just because they had a question and they called their accountant. So what we like to do is get these packages set up with a flat annual fee and divide that by 12 and then have them pay monthly. So it's easy to budget. It avoids surprises. And when we build these packages, we're really focused on making sure that we're including everything we know we're going to be doing for that particular client. So it fits the client, or I guess each client can fit into the appropriate tier that works best for them. And basically what I feel it does the best is it provides the ability to focus on the relationship and avoiding the concerns of getting an extra bill. And overall, it's just taken a big step for us to be a lot more comfortable with our clients, and our clients a lot more comfortable with us on a day-to-day basis because they know it's included and it's just a good fit both ways. And so we have those buckets of services, and then there's also some add-on services that could always pop up. A lot of these, or some of these are maybe one-time things. Others might just get added into and be a recurring service that we provide. But Jeff, you want to talk a little bit about what each of these is providing for our clients?
Yeah, so from time to time, we're always going to be moving in and out of different services. And some of these add-on services are things that may be built into your package, like an accounting service, tax preparation, tax minimization. Sometimes those are always in there, but one-time items like entity selection or maybe retirement planning, estate planning may be from time to time. Those are things that we can add on throughout the year. And so we're just trying to give you a feel. We're so huge into our process. We think if we have a consistent process with consistent expectations from our clients, that it really helps develop a really great relationship that we can continue to build on. And of course, great relationships then build trust, and then that trust yields into better results, we believe. So, one of the things that we want to talk about too is our tax planning process. We usually sit down about 2 months before year end. And really, it's almost like it's not optional for us because we feel like it's so important. If we don't sit down with our clients from time to time, if we're just doing tax returns, it just doesn't seem like it's enough. And so we learn so much from those face-to-face or sometimes those Zoom meetings that help us help the client more. So Today's meeting is about why tax planning is important. And so some of the things that we're going to go over is things that require quite a bit of detailed understanding by the client. And so, sometimes I think that prepaid expenses are one of those things that we take for granted, but there's some rules that we need to follow and make sure we're doing them correctly in order for those things to assure deductibility in case we're audited and it holds up under IRS scrutiny. So one of the first things that we want to talk about today is prepaid expenses and some of those limitations. And so prepaid expenses are something that almost all of our farmers are doing from time to time, some more than others. But let's just talk a little bit about, there's a little bit of guts to this that sometimes I think we take for granted. And so the IRS has some tests that we need to be able to pass in order for these prepaid expenses to be deductible. And so one of the biggest things that I get concerned about and we focus on with our clients is making sure that it's an actual purchase. And what I mean by that is if we're buying things that are lacking of a specific quantity, then that's kind of a trigger to the IRS that this may not be an actual purchase. There shouldn't be a right to any kind of a refund. So if the specific purchase has an ability to be refunded by that vendor, then that lends itself more to a deposit and not a purchase. And then if the seller is actually recording these as a deposit on their books, that's really not a good sign. And again, can jeopardize the ability to deduct these prepaid expenses. And if there's rights to substitute other goods or products, again, another sign that it may not be an actual purchase. So test number one, it's got to be an actual purchase. And these bullet points under here are things that we want to take into consideration as we're deciding whether we meet that test or not. So test number two, must be a businest purpose other than to avoid tax, which kind of is a tongue-in-cheek. You kind of chuckle a little bit when you hear that because, of course, we're trying to postpone tax. But in order to show that to the IRS, we need to have reasons why we're making these purchases. For example, especially in this environment that we're in right now, making sure that we're getting adequate quantities for the next year. So some vendors are requiring that in order to secure product for the future, we need to go ahead and purchase that now. Especially in the environment that we're in now, where prices seem to be on the rise, is making sure we're locking in those prices so that we can understand and compute our break even for next year and do proper planning as we start to market our grain. If there's discounts involved, then those certainly lend itself to more of a business purpose. And then test number three, it cannot be, in terms of the IRS's view, a material distortion of income. And here's what we mean by that. What's the quantity purchased versus what we expect to use? So we can't go buy seed for 3 years in advance and then write that off in the current year. Kind of an extreme example, but that's kind of what we're talking about there. Same thing with any fertilizer or any other type of a fungicide chemical of that nature. We can't just over purchase this to get our tax down. And what's our normal and business practice? What's our what do we do as a customer? Is this pretty normal for us to take this approach for prepaids? And usually anything that we can use in the next 12 months typically will pass this test. So these are the 3 tests that we need to keep in mind as we plan at the end of the year as we're making prepaid expenses. And then there's one more, what I would call a statutory limit. We cannot prepay more than 50% of our current year expenses. And so what that means is, let's just do an example to kind of illustrate that. So in our example of the 50% test, so we've got old McDonald who has total farm expenses on his Schedule F of the 2022 tax year of $200,000, which includes depreciation. So 50,000 of this 200,000 is prepaid seed. So since the 50,000 is less than 50% of the remaining 150, so we've got 50,000 out of 200,000, 150 is current year expense. So we can prepay up to half of that 150 in the current year. So that makes the entire 50,000 deductible in the current year. Now, on the flip side, here's what we've got. What if we're not meeting the 50% test? So same facts as above, except for the prepaid expense is 75. Since 75,000 is now greater than the 50% of the remaining 125, then, excuse me, the taxpayer would then be limited to 50% of the 125 current year expense of 62.5, with any remaining will carry over to the next year. So these are things that need to be paid attention to, and that's why we feel so strongly that instead of more of a do-it-yourself model, this is something that we harp on to sit down with our clients and go through this. The next thing we want to cover, and again, another example of why pre-planning is important, is we talk about depreciation. And so farming is a very equipment-intensive business. And so equipment's always going to be a part of the equation. And so most farmers out there that I deal with are very familiar with the term Section 179. This is a code section in the IRS that allows us to depreciate the purchases that we make 100% in the first year, up to a maximum in 2022 at least of $1,080,000. Now, for most of my farmers, they don't reach that maximum. I've only had it on 2 occasions where a hog confinement facility was purchased in the same year as a combine, and both of those qualify for 179. That's been really the only time we've ever got into the maximum deduction. The total equipment purchases, this is a small business deduction, so again, most of my farmers are not going to be purchasing more than $2,700,000 in a single year, so this usually is not an issue. The property that's eligible for this, usually 3, 5, 7, and 10-year property, and so tractors, which would be either a 5 or 7-year property, depending on whether it's new or used. Office furniture would be a 7-year property, and then your hog confinement facility would be a 10-year property, and then your 3-year property then would be your semi-tractor. Does not include farm buildings. So Section 179 expense does not allow us to do farm buildings with that, but hang on. And again, the thing I like about 179 is it allows us to have a scalpel in terms of where we want to be tax-wise, because let's say we spend $500,000 on equipment, we can elect to deduct half of that, 3/4 of that, anywhere from the amount that's required to be depreciated all the way up to 100%. So it really allows us, this is a great tool for us because it really allows us to get where we want to be. And so when we talked about farm building, bonus depreciation is the savior for being able to take care of our farm buildings. And so this was brought up in basically in the financial crisis of 2008, and it's remained on the tax laws since then, meant to incentivize capital investment and stimulate the economy. So the difference between bonus depreciation and Section 179 is we also get to include not just the 3, 5, 7, and 10-year properties, but also the 15-year property, which for most farmers would be tiling, any land improvements, as well as a 20-year property, which is our farm buildings. So the nice thing about bonus is there's no limits. So if we buy $20 million worth of stuff, we can deduct $20 million worth of stuff. With the 2018 tax law, this also includes used purchases. So really gives us a lot of flexibility, and like I said, includes our farm buildings. And so when we're putting up a $100,000 or $200,000 farm building, which would normally be depreciated over a 20-year life, this gives us the ability to take all of that in 1 year. Now, the thing about bonus depreciation, it's kind of an all or none thing. You either take all of your bonus depreciation, which means it's 100%, or you elect out a bonus and you choose another method. And again, that's why sometimes Section 179 can be a better answer. But then with this 20-year and 15-year class, bonus is our only option to get those done. So again, when we talk about the importance of tax planning, if we are not planning for these things and understanding the different levers that we can move in order to get where we want and maximize our deduction in the current year, then those things just go by the wayside and we miss opportunities. And so the one last thing about bonus is 2022 is going to be our last year for 100%, and then next year we go to 80, and each year after that we drop by 20%. So if you're thinking about doing farm buildings, we need to get on that sooner rather than later, unless we make a law change. We're going to start seeing this bonus phase out here over the next 5 years. And again, to put a bow on the equipment section of our presentation today, it really is one of those things where we may not want to prepay in a year where we buy heavy equipment, because we can utilize the equipment to get where we want tax-wise, and we can save that prepay for next year when we don't have as much equipment purchases. And so those are, again, things that we go over in our planning sessions with our clients. Without that, we're just driving the plane with instruments, and we get without instruments, and then we get to preparing the tax return, and we're limited in our abilities to get where we want to be. And so Jake is going to talk about estimated payment options.
Okay, so first thing to consider is, are you a farmer? So what does classify as a farmer? And the code says 2/3 of your gross income must be for farming operations, and to be clear, it does not include cash rent, which is a pretty common avenue for income for farmers. But yeah, it's 2/3 of your gross income. So if you have some W-2 wages, you got some cash rent, but you also have a farming operation, you add all of them together, get your gross income, and then 2/3 of that needs to be in the farming operation. So that's what does get you to classify as a farmer.
And Jake, what I find with this is when we've got smaller farmers that may have to have side jobs or things like that, that's when this calculations become critical. There are some situations where it's a no-brainer. The farm, that's all the person does is farm, and so this is usually not a calculation we worry about. But in order to take advantage of these estimated payment options, you have to be classified as a farmer, which means 2/3 of your income comes from farming.
And so what options or flexibility does it provide to be a farmer? And so the first one is, instead of being an April 15th filer and having estimated payments quarterly, which is a common for most taxpayers, you have the March 1st file and pay deadline. And so you don't have to worry about paying throughout the year, and you just gotta make sure you get your tax information to your preparer in time to get the tax return, not just pay the tax, but also file the tax return by March 1st. So sometimes you do run into the example of not having all the information you need to get your tax return completed. What's the best example of that? The investment statements.
Well, that's the thing that we run the most in right lately is thank goodness some of our farmers are actually not putting all their eggs into one basket, and so they're branching out and putting some of their excess funds into some investments. Well, what that's doing for us is those, if you've got any of those, you realize that sometimes those investment statements don't come until February 28th or sometimes till after March. So this file and pay by March 1st really becomes a challenge. And so, Jake, let's talk about the next option that's up for farmers is the pay by January 15th option.
So January 15th option to, again, if you can't get your return filed accurately by March 1st, you do have the January 15th option of, instead of paying quarterly, you pay one time on January 15th. So the most important thing is to either cover 100% of last year's tax liability, or at least 90% of the current year tax liability, and you just have to pay that by January 15th, which gives you the more time to file and pay any remaining tax that payment did not cover. Instead of March 1st, you have the April 15th deadline to get your tax return filed. Is what that basically is doing for you, is giving you the extra 45 days or so on that, especially if you're waiting on any statements. A lot of things are out of our control, so we don't really have that option of March 1st, and January 15th is a good way to not have to do the quarterly payments throughout the year.
And so just one quick correction on that. The January 15th is definitely 100% of last year. We only need to pay 2/3 of the current year for that to file by April 15th. And the one thing that I have noticed with this is again, with all these investment statements and really just getting things together on time, this is sometimes a great option for us for that purpose. But also when we sit down with our farmers, we're also analyzing what's going to be the best method for them in terms of cash flow. So for example, if last year the zero tax liability in the prior year, then we don't even have to make an estimate and we can file by April 15th. And so again, the importance of sitting down and going through that with our farmers is critical. And I think the biggest thing that I see is the ability for us to also look at cash flow and cash management. I'm sorry, I didn't mean to interrupt you there,
but no, that is the last point there is the cash flow. So that's what those options allow you to determine what you want to do, and cash flow, paying quarterly throughout the year, or holding on to that cash and doing it at once a year, whether it's January 15th or March 1st, is up to you, because those options are available.
And so what we're going to do, or at least what we plan to do with our clients, and we're in the heat of our planning season right now, is we're analyzing what makes the most sense. Is it better to file and pay by March 1st? Or is it better for us to use the January 5th payment, hold on to some of that cash, and then make the remaining payment April 15th? Or again, with farming being one of those industries that's up and down like a yo-yo, sometimes maybe the year before we're zero, and we don't even have to make any kind of an estimate. So we're not going to file by March 1st. We're going to hold that money as long as we can so that we can preserve our cash flow as well as maximize our cash management, which means, as we all know, we're in a high interest rate environment right now historically. So interest rates have gone up quite a bit. So where we haven't been able to really earn anything in a money market or a savings account, those rates now are starting to creep up to where I'm starting to see the option to get somewhere in the 3 to 4% range with excess funds. And so now those numbers are starting to become real, and then drawing on our lines of credit are no longer a 3 or 4%, it's more like a 6 or 7%. So again, this is, I think, managing cash flow and cash management is going to become more and more important as we move forward in this higher interest rate environment. Again, one of the last examples that we want to use to illustrate the importance of why tax planning is important is looking at different compensation alternatives. And so one of the things that I have noticed over the years, and I don't think it's an anomaly, is we've got a lot of farmers that carry over a great deal of grain from the current year into next year. And so eventually that grain is going to get dumped at once. Let's say we retire or we do a business succession plan. I just met with a farmer yesterday that has over a year's worth of grain held over. Well, he's about 10 years away from retirement, and somehow that grain's got to be converted into cash someday. And if we wait until the year that he retires, then all that $1 million is going to dump on the year he retires without any expenses to go along with it. So part of our strategy as we get close to retirement, and again under that concept of not putting all of our eggs in one basket, is for our clients to consider some retirement deferral options, which might be a SEP, a simple 401k, and when we have big numbers, we might even do a defined benefit plan. So again, these are things that we have to focus on during our planning meetings in order for those to be executed well. Another way that we can save money and can be an alternative compensation method can be commodity wages. And commodity wages is one of those things that can be a target for the IRS. And so it's very important that it gets done right. And why commodity wages are good is it allows us to pay either ourselves, our employees, or even family members that work for the business through commodities, meaning perhaps bushels of corn or grain or maybe even animal stock. And so by doing that, it does not subject those payments to payroll taxes for both employer and employee. So the key to that, though, is it's got to be done right. And what I mean by that, there's got to be specific things done to ensure that's correct, meaning we need an employment agreement. We need to document the transfer of those commodities. We need to make sure that the commodity is documented as well in a W-2 on the day of the transfer. And we have to make sure that any storage costs are not borne by the company, but are borne by the person that it was transferred to. So if we happen to be storing the grain, we need to charge that employee for that. If it happens to go to the elevator, they need to pay that storage cost in order for this to be done correctly and to pass IRS tests. So commodity wages can be a powerful tool. It just needs to be, again, I guess the best way to say it, we need to make sure the I's are dotted and the T's are crossed, consistently done through process. And then another item that is a compensation alternative, there's sometimes an opportunity to provide employer housing. So if you live on the farm or you have an employee that lives on the farm and it's really required for them to be there, there's opportunities to get tax-free housing under the right circumstances. And so again, all these four options that we just listed today are just a microcosm of the importance of sitting down and doing tax planning. We just wanted to show you some examples of how important it is to sit down with your professional and go through these items and make sure that, again, the details are being taken care of. If they're not done right, you risk the loss of deduction. So what we want to do is just kind of wrap this up now. One of the points we want to hit on, there's tax out there to be saved if we do the proper planning. And so hopefully we've hit that home today. A lot of times once we pass the year end, there's things that cannot be gone back and done. So it's really important, like we said, we sit down with our clients anywhere from 1 to 2 months in advance. The sooner the better, because we just don't like to rush through things and create these emergencies. That's when mistakes get made. And like we've harped on through this entire presentation, we are so big on our process. We want to make sure that our clients are getting consistent service, and the way that we do that is through a consistent process. And what Jake talked about with our Farmer Boss system, that just allows us to be able to deliver those services in a consistent manner, and our whole team knows what our objectives are when it comes to serving our farmers. So, hey, we want to thank you all today that showed up and listened to us. Hopefully you got something from it, but if you've got any specific questions, certainly I'll keep this slide up on the screen for a while, but certainly send us an email, or if that's not a possibility, don't be afraid to call. We'd be happy to help give you some counsel on any specific questions you might have. This is Jacob Brown, my partner. I'm Jeff Milligan. Really appreciate you being here today.